Silicon Valley Bank collapse. I'm chatting with Colin. He made some tweets on Twitter about this, so I thought we would chat. Colin, thanks for joining me.
Hey, my pleasure.
Well, I guess before we get into this, the first thing that my people want to know, did Voxter have its cash with the Silicon Valley Bank?
Oh, no, they're with the Bank of Montreal. So, yeah. No.
Okay, now that we have this out of the way, you did some work, so I want to pick your brain. What the hell is going on? What is this? Can you give us some light?
Well, I'm not obviously a banking expert. I do understand. I've been reading about this for the last little while. Um, I'm fairly knowledgeable about Silicon Valley Bank. They've been invested in a number of companies that I've dealt with in the past. They're actually an excellent lender to the earlier stage technology companies, obviously through their expertise and knowledge of technology, and then just understanding how um, the companies work and understanding technology growth and all their needs and so on and so forth. So they've been an excellent, excellent bank. And in fact, I think in many ways they've been a bit of a secret weapon of the US's startup ecosystem. Um, and there have been a number of major beneficiaries of this, not the least of which is the US's uh, being at the forefront of technology. I think is in large part because of uh, not only the VCs and the private equity firms, but also having this banking partner that can help accelerate growth and having the proper type of lending criteria that will not encumber these earlier stage companies. So I think they've been an excellent tool in growing the ecosystem down in the U.S. Obviously there's some people making overtures to 2008. I think the in the case of 2008, that was really a function of not regulating an industry enough and allowing all these derivative products to be created, and they were, uh, being built on top of an already fragile real estate market that was ever expanding on ever more marginal borrowers and buyers of real estate, and because of some of these like the synthetic um, credit default swaps and all these other synthetic products that were being created, it allowed them to create massive leverage, and then it was all based on a very bad base. Whereas in this case, really what's happened is that you had a whole bunch of cash come into Silicon Valley Bank over the last few years because of the success of technology companies. And one of the monikers, or one of the things that Silicon Valley Bank was, if they lent money to a company, then that company had to have their cash deposits with Silicon Valley Bank. And so um, that was sort of one of the reasons, and it's part of the issue of sort of you get this recursive nature in some of these types of situations. But I think the biggest problem is that when so you think of the cash on deposit, they have all this money coming in, then they went out and bought mortgage-backed securities, and then they also bought longer-term U.S. Treasuries. And the biggest issue was that the duration of the bond portfolio was too sensitive to interest rates going up. And so as interest rates went up quickly, if you have a longer dated treasury or a longer dated bond period with low interest rates, those are the most sensitive to either inflation, which we have, and to rising interest rates. And so what happened was it's not that the underlying assets that they had were bad. It was that the mark to market of a lot of their assets was causing a cascading effect in terms of the liquidity and solvency based on a mark to market. Do I think if they owned a U.S. Treasury at 1.39% that they were going to lose their money? No. But what was going to happen is that you get this convexity in the yield, in sort of the pricing, and as a bond, so let's say a bond drops 25-30%, as you get to maturity, what happens is that the bond gets ever and ever closer to the face value. But so let's say, for example, you have a 5-year bond, it's dropped 35%. As you get to, and if you think, okay, I'm going to get paid back over time, then you hold it to maturity, except they have a mark to market issue, and it looks like on face value they've lost that money. So I think a lot of what they're talking about is there's this mismatching of the value of the bond portfolios mark to market, but it wasn't really that these are bad assets or that they weren't going to get paid back. So
what you're saying is, I mean, it's the Fed raising interest rates that caused this problem for them.
100%. I mean, this is, everyone has been saying that I was explaining to my girlfriend yesterday, I was saying, look, I can get out of this building. We can take the elevator, we can take the stairs, or we could jump off the balcony from the 20th floor. Well, if we do that, we survive if we take the stairs, we survive if we take the elevator, but we don't survive if we take the balcony. And so it's a function of the rate of change. It's not just the destination. We're all going to the ground floor at that rate. It's just the rate of change of the balcony is what kills you. And so when you take a bank like Silicon Valley, they have this issue where I think they were probably focused more on the yield matching to their deposits rather than on the duration and the convexity of their short-term obligation and their long-term assets. And so what happened was they get caught up in the seismic moves of the bonds, and all of a sudden the value of their bond portfolio gets smoked. And then these rules that are there that are supposed to protect and create safety, actually, I think in many ways are causing part of this problem, because I just don't think that they have and again, I'm not a deep expert, but it doesn't sound like their assets are bad. It sounds like there's just a mismatching of the duration of the two different obligations. And so I think that somebody's going to come in and potentially buy this bank. What I'm thinking might happen is that maybe Apple, Google, Amazon, I don't know if Facebook would do it at this point. But I posted an article from Wired from 2019 where they're talking about, all these tech companies want to be banks. And if you look at the cash value, the cash position of Google, Apple, Microsoft, I mean, any one of these guys could refinance this company with $5 billion because they've got $100 billion in their bank account. 60, 70, 80, $100 billion. I mean, they've moved some of their stuff out of pure cash and into some type of investments, but they literally could buy this in a heartbeat. And part of my thinking is this, and then I want to be clear, this has been shaped by many different people and readings, but it's not lost on me that these banks are amongst the these tech companies benefit massively from this ecosystem because this is where they buy up all of their new technology companies, or they invest in other companies and they get to see what the ecosystem brings to them. And so they're net beneficiaries of this very vibrant startup VC PE ecosystem. And they've all been moving towards banking anyway. So I think this is a slam dunk. I shouldn't say slam dunk, but to me, it seems like it's an obvious case of they come in, they buy up these companies, and they become the hero, and they become and they save their own self. I mean, this is not altruistic. This is I think Silicon Valley Bank is a very good business. I think it stabilizes an ecosystem of which they're great beneficiaries. So I see this as they become the hero. They got the cash to do it, and it gives them a whole bunch of tools. So I wouldn't be surprised if Apple, Google, Amazon, someone took a swing at this, just because they have the cash to do it. It would be a useful. I mean, if I was one of them, so I'm going to like, where am I going to deploy capital in a very useful manner? I would say that this is a very useful manner. Now, maybe Google, Amazon, and Microsoft come together and buy it as a collective, because they all benefit from it. So,
but if
I don't know.
if that were to happen, like, I mean, there's companies out there I'm reading that, they can't make payroll, right?
That's
So
right. Yeah,
like
they can't. Yeah.
so like, what would happen to their deposits if such a situation were to happen, that the bank gets bought out?
Well, everything is secured at that point. I mean, I think what happens, if this thing, and I'm going to, I don't want to be overly optimistic, but I suspect that this will get cured before Monday open of the market, or maybe I hope that it gets cured before the opening of market. And the reason is that in the 2008, it was really like a disease spreading through the financial system. And while it was a big problem, it was sort of in many ways less complex, because you could sort of target who the big banks were, and you could shore them up, and you could say to everybody, we're backstopping everything, and you sort of restart this thing. To me, this is like trying to, like one of those massive balls of yarn, and you cut it, and then you're trying to stitch it all back together and get the different connectivities of the different pieces of yarn together. There's just too much entropy in the system. It's too complex. If this breaks, I think this causes much more damage, because you have now the company can't make their payroll. Now a person can't pay their mortgage. Now a person can't pay their car. A person can't pay their university. A person can't pay their rent. There's just such a massive cascading effect if they let this ball of yarn get cut, and then they're trying to restitch it all together. So, the 2008, I don't think there's any similarity, because it's not a systemic problem. But I think this has the contagion is a much more complex contagion than the 2008 financial crisis.
Now,
And so,
if the Fed raising interest rates caused it, do you think the Fed might think twice about what they're doing with interest rates because of this?
I mean, I think they would have to be completely clueless not to look at this and go, whoa, oops, I mean, it's like the kids roughhousing in the dining room, and they knock over an expensive piece of china, and they're like, "Boo, shit, we're in trouble now." So, yeah, I think this is, a serious wake up call, to, and a serious wake up call that is, if you move rate of change again, off the balcony, down the stairs, take the elevator. One of those kills you, two of them don't. And if you increase the rate of change too much, you're basically throwing these companies off the balcony. And I think that's what we have here, is just that they didn't anticipate that the rate of change like this was going to cause this type of damage. Now, do I think they should have contemplated? 100% they should have contemplated this. And in many ways, I also think this cranking up of interest rates is actually not going to solve some of the inflationary pressures that they're trying to curtail, unless you're just trying to melt down the entire economy and put everyone out of business, and then you have a Pyrrhic victory. Yes, you've tamed inflation, but everything else is burnt to the ground. I mean, I don't think that they're looking for Pyrrhic victories, but they have now been given a front row seat to some of the problems that they're causing. So, I think a lot of people are like, oh, maybe a Wells Fargo comes in and does this, maybe JP Morgan, I don't know, pick a bank and they go in and save this. That may make some sense, but I wouldn't be surprised if an Apple or a Google or a Microsoft came in. I mean, these guys have cash levels. Like 2 years ago, I think, or 2022, I think the cash level of Apple was like almost $200 billion. I mean, that's the level of assets of all of Silicon Valley Bank. So it's not unheard. It's not to me like some sort of crazy idea that these guys could take over these banks. These big tech companies could easily do it. And it's in their own self-interest to do it because they're net beneficiaries of this ecosystem. And also, this solves a big political problem. And also, quite frankly, it solves the problem of taxpayers in the US not having to foot this bill. But so is it a bank, a traditional bank? Quite possibly. Is it one of these Googles or Amazons or Apples? Could be. I mean, they literally could do it with a pittance of their maybe not a pittance, but less than 2-3% of their overall cash positions. And so they could go in and actually take this over, and it would help them as a business tool and would give them huge insights into the ecosystem that they benefit from. So is it Amazon, Microsoft, and Google? Is it just one? Who knows? But I think there's some real merit to one of them coming in and fixing this.
All right. Well, okay. Well, thanks for doing this.
Yeah, no problem. Okay, man. We'll talk soon.